Hey everyone, what's up? It's Seth. I'm back. Today I wanted to go over kind of some more light bulb moments I have across my dividend journey. I absolutely love dividend investing. I think it is the best. I guess kind of what I want to do is go over these light bulb moments and maybe you guys can find some value in it. This definitely isn't investing advice, but it is for entertainment. But I can share what I learned and maybe you guys can go and do your own research on what I've learned. But before I get into anything, I just want to quickly show you what I have. I have 25 different holdings. Here they are. I got about $9,100. I have SCHD, $6,000 in SCHD. And in real estate, I have O and WPC. I have about $1,000, which brings my current value to $16,764. And I can show you my portfolio right here. I have a dividend yield of 3.1%, dividend growth of 11%. My annual income is at $526 each year. That's where I'm at. Now, I wanted to share that, but before I give these light bulb moments, let's just lay down some foundations that we can all agree on, right? And that is investing in great companies that raise dividends every year is the way to go. That is the type of investing that I do. Now, I also want to be clear that for long-term holders, dividend growth is just as, if not more important than current yield. Right? If you're holding for the long term a stock with a current yield of 4% and 10% dividend growth rate will overall yield more than the stock with a 6% yield and a 3% growth rate. Right? In 7.5 years, it will yield more. Right? So this just goes to show that chasing yield is not always the best, right? And that's something that I had to learn when I was fascinated with all these companies with high yields like Verizon or AT&T. I realized that there might be companies out there that are better for me, and that's just my personal opinion, and you guys can do some research on that, but that's just where I'm at. Now, how I went about building my portfolio is I wanted principal, all right? I wanted a good total return. I also wanted annual dividends to come in, right? I wanted to reap those annual dividends, and I didn't want really low yielding stocks with a high total return. I wanted a little bit of everything: good dividend yield, good dividend growth, and a good total return. So I want to go over 3 stocks today that are in my portfolio that have a bit of both, right? One that has a low yield, one that has a medium yield, and one that has a higher yield, right? And we can see kind of the calculations and how everything plays out. I think it's really interesting, and I think this can be of value to you all. So check this out. Costco. A low yield, 0.79% dividend yield, a low payout ratio, 25% in the last 5 years, a good dividend growth at 12%. This is a great company. Now, when you plug all these numbers in, right, if you start with my principal of $16,000 and I invest about $28,000 a year into this account, that's the track that I'm on, right? I plugged all these numbers in right here. You can see. And I back tested the expected annual share price appreciation, right, per year. I back tested that in the backtest portfolio visualizer, so I'll put this all in the description for you. You can see that after 20 years, you have a pretty high principal of $4 million and annual dividends of only $11,000 and a yield on cost of only 2%, right? So you have a high principal, but low annual dividends and a low yield on cost, right? So this is one way to go for investing, and I do have this in my portfolio, right? But for me, I also want higher annual dividends and I want higher yield on cost. So let's check out Home Depot, right? So Home Depot has a little bit higher dividend yield of 2.3%. You can see that its dividend growth rate the last 5 years is 18% with a low payout ratio of 46%. It has a dividend streak of 34 years without a reduction. Pretty good. So I plugged in all these numbers here. 2.37, 18. I back tested it at 20.5%. And that's without dividends reinvested, by the way. That's the annual share price appreciation. Now, check this out. High principal, $6 million. A nice annual dividend of $99,000 each year by year 20 and a yield on cost of 18%, right? So a little bit higher than Costco. And the last one I wanted to go over with you guys was Rowe. Right? So check this out. And this is something you guys can do when trying to build your portfolio, kind of back testing all these companies. Rowe has a dividend yield of 4.3% and a payout ratio of 50%, pretty good. And the last 5 years, dividend growth rate, 15%. So I plugged all these numbers in right here. Wrong one sec. 4.3%. 15, and its expected annual share price is 6.8. So now invested 20 years. Check this out. A lower principal of $2.8 million, but check out the annual dividend. $503,000 is the annual dividend with a yield on cost of 91%. Now, nothing is certain, but that's just saying that Rowe stays at the dividend growth rate it is, and it stays right at the current yield. Right, so this is just absolutely insane, you know. So again, this is nothing is certain here, but it's just cool to see, right? Like, this is maybe the future for this company. Who knows, right? No one knows, but paints a completely different story than Costco. You can see Costco overall has a higher principal of $4 million, but it has a much lower yield of $11,000 annually and a much lower yield on cost, but it does have a higher principal. So it depends what you guys are going for and where you're at. Now, I also did SCHD, just for everyone, because I know everyone loves a little bit of SCHD, right? Dividend yield 3.38%, dividend growth 12%. So I plug these numbers in here. Boom, boom, boom. Everything's right there. Check it out. Principal of $2.3 million with an annual dividend of $102,000. Yield on cost of 18%. Now, I think this is great for an ETF, right? A lot less risk than just investing in one company. So you can see that putting everything in SCHD could be a way to go, right? That's why a lot of people love it, because the numbers don't lie, right? Living off of $100,000 in dividends by year 20, I'll be 45. If I keep investing what I invest every year so far, that's not bad. And this is with the tax rate included at 15% tax rate. You know, so these are kind of just some light bulb moments that I had where, you know, going, oh wow, like this is really the future for some of these companies based off of the past. So I'm basing everything off of the past, and these are just some light bulb moments that I've had. So I wanted to share this with you all. I think it's fun to research companies like this, and maybe you found some value in how to research companies. I know that I love doing this, and I spend a lot of time doing this, so I want to share that all with you guys. But, you know, I really appreciate your time, and I make videos every day, so I'll see you all tomorrow. Bye.